Gopal Gare, Managing Director with Bernstein, joins us now. Venugopal, thank you for joining us. Let's understand with your view of the world. Exactly a week ago, the concerns for equity markets were abundant. China, US macro data, and Middle East crisis. At least for the moment, two out of those three concerns have taken a backseat.
I think we need to be a bit more concerned about India's own drivers rather than what has happened externally, in my view. So if you were to just think through, my concern externally is not really much linked to China, because I think the China recovery, for whatever the reasons be, is actually positive for India, not negative for India, in my view. We can discuss that, but that has been my stated view. Middle East, broader concerns as to what could happen to crude and commodities in general, it's something that we need to watch, because that's going to be very volatile and could shape up very differently from what one would want it to expect, or expect that to happen over the next couple of months. So we still need to keep watching that aspect quite closely. But I'll bring us back to the broader India perspective itself. I guess we are going through potentially some phase of fatigue in the economy, as I said, and that is something which is going to impact earnings as well. So we need to watch more for that as a challenge for capping Indian equity returns than anything else.
So let's talk about specific of India, since you've flagged it off and you've been writing about it. What are the indicators which are telling you that things are moving from growth to slowdown, or growth has plateaued? Give us three examples or indicators which are giving you a sense that things are now plateauing out.
Yeah. So very top down, I would just highlight that since data is broadly on the macro front, pretty closely tracked. If you were to just look at the two main drivers, or two, three main drivers for the economy, one was government capex. Government capex data clearly suggests a pretty material slowdown over the last couple of months. And that data is, of course, available. Yes, there would be some room for a catch up in second half, but then on a full year basis, I guess you still miss those numbers, because you can't really catch up on capex if you missed spending for a couple of months. So that's one major driver sort of turning sort of negative. The second aspect I would probably say is on the consumption front. The drivers, which were largely centered around upper end urban consumption and premium, is starting to see a fatigue. Very, very clearly, you can see two-wheeler premium sales flattening out for the year. SUV sales have started to moderate compared to last year's momentum, while affordable is yet to see a recovery. While at the same time, we're going to see generic retail sales based on data from Retail Association and others, that's also starting to slow down quite a bit into the last few months. Now, what it means is that as we head to the festive season, you're going to see a lot of discounting appear and emerge across the board for corporates and products to ensure that you get your volume growth, right? And of course, that's not necessarily great for margins. And more importantly, if you then, build anything which are derivative drivers, be it, aspects around IIPs, production levels, and things like cement demand, or across the board, you basically see some degree of fatigue, which is more derivative in nature in terms of demand. So these eventually have to reflect in numbers, even if these are episodic and even if there are intermediate sort of fatigue factors.
Okay, so let's look at one data point which is classic: PV sales and CV sales and two-wheeler sales. While PV sales are now plummeting, two-wheeler sales are making a comeback. Why is that we are getting such a divided picture within autos, which always is the biggest and the most best high frequency indicator? Same time last year, rural India was under stress, two-wheelers were down. Now two-wheelers have come back and passenger car or PV sales are down. How should one read into this auto data as an indicator of consumption demand?
Yeah, so a very fair point. Auto data, unfortunately, is not synchronous at this juncture, partly because of the COVID-led impact in terms of what recovered first and what started to recover later. Now, if you were to broadly characterize this, passenger vehicles had sort of hit on to absolute volumes, which were higher than pre-COVID levels sometime early last year. And thereafter, still some momentum continued, but then we've started to see fatigue in general in passenger vehicle sales, which is both top end, which was a major driver last 3 years. And remember, there is no affordable recovery happening. Now, that tells you that the top 40 million households, which have been the drivers for the economy, are essentially not necessarily incrementally, seeing that kind of a momentum. That's one part of the story. The second thing is, if you look at two-wheelers in general, bulk of the demand that you see in two-wheelers is stacked up in the mid-end of the vehicle range. As far as top end is concerned, which is premium, which we call greater than 250cc, is actually flattish through the year. And that was actually quite decent last 2 years. So in theory, even if you were to just pull through the views on what is happening on two-wheelers, the top end is still not necessarily great and actually seeing a moderation momentum. And we're not really seeing any major signs of recovery in affordable as yet. So it essentially means almost similar to PVs in terms of thinking, in terms of the economic impact. CVs, just wait and watch what will happen in the next few quarters. Things are going to slow down materially from here. Firstly, CVs anyways had picked off and came closer to flattish numbers. But then what we are hearing on the ground from various fleet operators and others is going to be very bad the next few quarters at least. So you're going to see the momentum moderate even further from here.
Is it then that you're seeing opportunity or a revival in demand and capex? I believe there are some opportunities within the power sector, according to you, that look promising.
Yes, so I mean, in a very medium-term approach, we have been of the view that government capex as well as transportation capex has peaked. It's a reality which is very hard to understand, but it is happening and it is going to happen and be visible in the next few years as well. Power capex is just starting off, which means it will be volatile. But then if you were to really position yourself towards playing the momentum around power sector, because there's a need, both around transmission and around renewables, keep looking for opportunities around there. It's a 3-4 year cycle. So it's just started last year.
You know, Vinu, the big talking point is the kind of disruption which is currently at play in the Indian markets with regards to Q-commerce and the kind of impact it's happening on the traditional, mom and pop kind of retail stores. And I'm talking about the backdrop of Avenue Supermarts this morning. But do you really think that Q-com is going to sort of overtake this entire space?
Very, very topical and important question, given where we see Avenue Supermarts opening today in terms of stock price. See, if you were to, I actually, find it a bit difficult to believe at an India-wide scale, you're going to see an impact on kiranas in general, at least in the next couple of years. Because it is Q-commerce was to a large extent an urban phenomena. And yes, they are looking at tier 2, tier 3 as well. But if you just look at size construct, the entire quick commerce market is probably a couple of $1 billion, $2 or $3 billion. It's sub $5 billion. It's primarily a $500 billion grocery TAM in India, which is the actual sales or retail sales, and $1 trillion retail sales in India overall. So I really don't think that at where we are in terms of Q-commerce, it is going to be that big or that impactful in terms of overall India kiranas. The second thing is, for someone like organized retail itself is very small in India at this juncture. And they are impacted because they're trying to buy the same customers, especially in urban areas. So it does impact your mature sort of retail outlets, which were originally commenced in some of these urban areas, right? So, but then they do have an opportunity to scale up quite materially in tier 2, tier 3 and beyond, which is what is going to be a positive driver for them going forward, because they're going to displace kiranas in a tier 2, tier 3 from a value construct. Third thing, remember, is quick commerce is convenience. It's not value. And it is hard to believe that you're going to see quick commerce. By the way, we're positive in quick commerce. I'm still saying that. It's hard to believe it will be $50 billion in 3 years, right? So it's not going to be that disruptive for the overall ecosystem to be impactful enough, because I think convenience TAM itself is relatively restricted. Indians are not rich enough to, just buy everything at MRP.
But is the bigger overweight going to be on Q-com as opposed to traditional retail?
We are very positive in quick commerce. So in that sense, some of the quick commerce names, both upcoming as well as the ones which exist, we have overweight stance on them. Now, interestingly, I do like organized retail as well. So I think this is from a pivot point of view, it's a very unique situation where we are positive on both at this juncture, right? And I think it's going to play out over time in a fairly different way, but we're currently overweight both. Quick commerce is preferred over organized retail, and both are preferred over traditional retail. So that's the way I would position it. So it's a question of valuations as well, right? So that's another thing which I don't want to discuss right now, but that's another variable that does come into equation in terms of how much returns you expect on a 12-month view. But we are overweight quick commerce, pecking order wise.
So let's
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.